In our strategy, we track risk through a 5-phase cycle. We are not predicting headlines. We are tracking signals and sequencing. This signal rarely moves markets immediately, but when it does, it changes how fast the next phase arrives. Stay with this, because the payoff is which markets react first. We are reviewing a detailed macro breakdown tied to JPMorgan's earnings. The focus is corporate bond issuance and credit behavior. Watch the original for full context, then use this to map it into our strategy. JPMorgan missed expectations, not because something collapsed, because bond underwriting was weaker than expected. Bond underwriting is a credit signal. It reflects issuer timing, investor demand, and dealer balance sheet capacity. When it slips, something underneath tightened. The claim is simple. Deals expected in December did not close on schedule. Some of that supply appeared later, in early January. This matters for sequencing, not timing. Credit markets do not shut down all at once. They hesitate first. The video links that delay to funding friction. If repo conditions tighten, dealers get selective, and marginal issuance becomes harder to place. Equities can stay elevated while credit quietly deteriorates, because price can float on narrative, while the system tightens mechanically underneath. The video emphasizes fallen angels. Issuers near junk status expand forced selling risk, not today, but when conditions worsen. In true Goldilocks, nobody asks questions. They reach for yield. When questions return, risk aversion starts at the margins. Investment-grade issuance softened in December. High-yield issuance looked stronger by comparison. That mix can be a warning, not comfort. The curve can steepen even with long yields not collapsing. Front-end pressure can be downward from growth concerns. Long-end pressure can be upward from term premium and supply. In our strategy, this reinforces Phase 1 fragility. It does not confirm Phase 2 forced selling, but it raises sensitivity to shocks. Before this signal, Phase 2 risk sat in a lower range. This nudges that probability higher. Not certain, but closer. This is not a buy window, but it is no longer distant. We are approaching ladder watch territory if more signals align. These are not buys. These are the tickers most sensitive if this persists. SPY for risk appetite, TLT and zeros for duration sequencing and credit stress proxies that move with spreads. Exit discipline tightens on late-cycle equity exposure. Credit signals move higher in the signal stack. Optionality becomes more valuable. This does not invalidate melt-up participation with exits. This does not justify flipping the whole plan. This does not confirm a cascade. Quick disclaimer, this is educational macro commentary, not financial advice. Which signal breaks first in the next phase shift, credit spreads or labor? We do not need to be early, we just cannot afford to be late.